that note, go ahead and introduce our speaker today. My wife has already introduced Jim this morning to Morning Tea, so I won't be too repetitive. But Jim earned his PhD from Purdue in 1980, and he is currently J. Garn Professor of Finance at Utah. His academic career has been characterized basically by monogamy with occasional flings. He started off at Utah in 1980, and that's where he stayed the whole time, but he has visited at Vanderbilt and Berkeley in Florida during that time period. And again, as my wife mentioned, he's got a great record, approximately 200 citations in other science. He's published in all the top journals in finance multiple times, JFE, JF, and JFQA, and he has a JPE. This is icing on the cake. And so I do want to mention here that when Jim was asking about what kind of paper he should present at the seminar today, he's got some polished papers that are good off the shelf he could have presented, but he's also got a work in progress here, and I encourage him to go ahead and present kind of what he's currently working on, and hopefully we'll provide some good feedback to him. So, Jim,
thanks, Bob. Yeah, please feel free to beat up on this paper because it's really, I mean, it's literally hot off the press. I finished writing it, I guess, last week, and put these slides together this week, and so this is the first audience for this paper, and you know, I think it's coming along, but I have my own criticisms of what we're doing so far, so I'd like to hear yours, and I think it'll be very helpful to me to get your feedback, and so I apologize for bothering you, but I think in terms of impact, it's going to be most helpful to me to hear what you have to say. The other thing I should point out is this co-work with a couple of former students from Utah, Kyle Wells and Ryan Whitby. Kyle is at a small school in southern Utah called Dixie College. And Ryan is at that Texas well-known school called Texas Tech, a rival of A&M and so forth. But the other thing I wanted to say in terms of introduction, I'm going to be using a lot of the words substitution and complements. But for an economics audience, I want you to know that this has nothing to do with income substitution or complementary effects in that way. This is just simply, are you going to substitute a lease contract for a debt contract, or when you add a lease contract, maybe in fact you can add more debt to the firm. That's the type of complement and substitute we're talking about here. Okay, the idea that we're trying to explore here is, are debt and leases, well, first of all, we started with the idea, are debt and leases different? You have to actually think about this a little bit deeply, because in reality a debt contract is very much like, a lease contract is very much like a debt contract, and you have to look at some of the market imperfections to realize why they might be actually different kinds of contracts. In other words, in a Modigliani-Miller perfect capital market world, there wouldn't be any difference between, it wouldn't have any value impact from the use of debt or lease contracts. So it's only with market imperfections that we can see differences. And here's a list I came up with quickly with different kinds of market imperfections: taxes, information costs, agency costs, bankruptcy costs, and cost of financial distress, transaction and contracting costs, and the legal and regulatory environments are some of the imperfections that causes differences between different types of, say, lease or debt contracts. Now, in the case of leasing and debt, let me make the following observation to you. First of all, there is a fundamental economic difference between a lease contract and a debt contract, and that is, with a debt contract, say, you make all of the payments. On a debt contract, you satisfy the obligation. You, the user, are the owner of the asset. But in the case of a leasing contract, you, the user of the asset, can make all of the lease payments, fulfill the entire obligation, But at the end of the contract, you typically do not own the asset. So now, that can all be priced in perfect capital markets, and again, that would not cause a difference between debt and leasing in terms of value. But if you add to that this important residual value component, if you add to that the idea that taxes could be different between these two types of contracts, and that is true in the US, it's also true in New Zealand. That is to say that the owner, it can be the owner, the lessor can be the owner of the asset and the owner for tax purposes, taking depreciation and other tax benefits, if there are any, for the asset. But you can't do that with a debt contract. You cannot transfer tax shields with a debt contract. You can with a lease contract. So that, again, is a fundamental and economic difference between the two contracts. And then this last point, bankruptcy costs or the cost of financial distress, this one has been promoted in a paper that I'll be mentioning in just a little while by Eisfeld and Rampini. And what they point out, which has been pointed out before, but they take it a little bit further, and that is the idea that the owner, the lessor, has legal rights to the asset in terms of repossessing. Well, so does a secure debt holder. But the bankruptcy laws in the U.S. are written such that there is an advantage to being a lessor in bankruptcy. That is, if the bankruptcy court approves the fact that you are a lessor in a true lease, and the lessee, who is the bankruptee, decides to confirm the contract, then the lease payments, that is, if the lessee wants to keep that asset, then the lease payments become part of administrative costs, the highest priority in bankruptcy. This is not true for secured debt or any other type of debt contract at the time of bankruptcy. So that has a very high, that gives lessors a very high priority in bankruptcy. And there's some other provisions in the U.S. legal code that gives lessors a tremendous advantage in financial distress. Or, for example, there's something called the finance lease in the U.S., whereby if you lease some equipment and the equipment is no good, the lessor does not provide any guarantee or warranty against the equipment. And even if the equipment doesn't work or malfunctions or is obsolete, the lessee is still obligated to make those lease payments, and the lessee has no recourse against the lessor. This has been upheld by many courts, and even sometimes in the case of fraud, the lessee still has to make these lease payments. So leases have, because of these regulatory and tax differences, it can be, it can lead to a difference between debt and leasing. Yes, Seamus.
Shouldn't that bankruptcy cost only create a difference in value if there's asymmetrical information? Right?
Yeah.
If there's equally known share probability of bankruptcy, then that will just get priced.
Yeah, I think I agree with you. The information cost idea goes along with that for sure, and that is kind of the argument that Eisfeld and Rampini make in their argument in their paper. Yes, John.
One thing I'm thinking about, it isn't in the list 1, 2, and 3, is the idea of moral hazard on part of the lessee with respect to the asset of the lessor.
Yes.
And in particular, I think of two things. The sort of moral hazard, are they going to abuse it? Are they going to run it down?
Right.
But I'm also thinking about renegotiation situations. So you've got financial distress as one, but another might be, okay, I leased a truck for a certain, I run refrigerated stuff. But then all of a sudden, refrigeration goes down and containers come up pretty cool. And so I'm the lessee. I'd like to take advantage of that. And maybe even the lessor would like me to take advantage of that. Or they might have some outside opportunity. Now, with a debt transaction, the lessee is a sole controller of all those unanticipated new possibilities. Whereas in the lease transaction, there's kind of a situation, a little bit of potential
Right, right. Or even in the case, some lease contracts allow you to sublease a piece of equipment and some don't. So, but you're right. I think it would require potentially renegotiation if you want to redeploy these assets in those situations. But in the case of agency costs, and I agree with you 100% that the lease contract by its nature means that the lessee potentially has less stake and more incentive to abuse the asset. There's a famous quote we were mentioning Larry Summers at lunch today, but he has a famous quote saying that in the history of the world, nobody ever washed a rental car. I maybe did it first, you know, because my car's getting kind of dirty, but I think that you also have to realize that these agency problems can be, again, in perfect capital markets, would be properly priced, and therefore it's hard to say that would be the difference between leasing and borrowing. But it definitely, and again, in the Eisfeld and Rampini model, they look at both this bankruptcy cost advantage to leasing from the lessor's point of view versus the agency cost disadvantage. That leads to their trade-off. And
there's a book called The Nature of the Farm by Doug Allen and Lewick. It's a fascinating book on agricultural contracting. And one of the issues that they kick up, there's crop share, which is cash rent, a classic one. But aside from that, there's ownership versus assets. And their sort of key idea is that land attributes have a lot of difficult to measure kind of characteristics. And so they don't get hooks. It's the imperfect capital market kind of analog here.
Yeah.
And then that's where it kind of makes a difference in you're sort of trading off overuse of unpriced characteristics.
Yeah.
That might be productive in a lease contract versus lack of specialization in sole ownership.
Yeah.
I think it's a big difference, but that's really
now, going back to some of this literature, since I know a lot about leasing, and this is some of the major literature in the area, and there's actually a whole bunch of other literature that I'm not even going to touch on, but these three papers here by Merton Miller and I think it's Charles Upton, Llewellyn, Long, and McConnell, colleague from Purdue, and Myers, Dill, and Batista. These three articles came out in 1976 in the Journal of Finance. And it's interesting, for example, the Miller and Upton model, you might be familiar with Miller's famous debt and taxes paper, where the idea that corporations get a tax deduction on interest, but they have to gross that up by the fact that the investors, the holders of that debt, are paying taxes on that interest payment. And so, but he stated, and I think it's actually written somewhere, that he got the idea from looking at leases, because the same idea holds there, that the lessor gets the depreciation tax deductions, but has to pay taxes on the lease payments, and therefore has to make sure that they cover their tax obligation in that way. So that was a fairly seminal paper in this area. Llewellyn, Long, and McConnell talk about, again, this sort of list of perfect capital market assumptions. There's no advantage to leasing. It's a zero net present value unless you start to add market imperfections. And then finally, Myers, Dill, and Batista, and this is one that's relevant to my paper here, is they talk about the lease or buy decision, and in part of the decision is how much debt substitutes for leases. And they actually have a parameter in their model called lambda, and that's exactly what I'm investigating in this paper. What is lambda? Here's their definition. Lambda is the parameter that represents the lease payments and the various tax shields. Lambda is a parameter that represents the lease payments and the various tax shields support at most lambda of debt per dollar of leased assets. So in their examples in the paper, lambda's 1. So there's perfect substitution between debt and leases. But it seems to be an open question as to just exactly what is lambda. So there's been a literature that tries to look at lambda. And the one that kind of started a whole cottage industry of analysis was Eng and Peterson. In 1984, they were trying to investigate lambda. And they found that it actually wasn't between 0 and 1, but rather it was less than 0, indicating that firms used more leases and more debt simultaneously. Now, the problem with that study is it was a cross-sectional analysis. And lots of endogeneity problems, but in particular, they're looking at firms that maybe are using a lot of, or have a lot of fixed assets. So they're just going to need a lot of financing, and they're going to be using a lot of debt, and they're going to be using a lot of leasing. And so they really can't say for sure what lambda is based on that cross-sectional analysis. So that was a fundamental problem with their study. But it kind of got me thinking, and I was visiting at Vanderbilt and met Craig Lewis there, and we started talking about this idea. And we built a model that shows that debt and leases can be complements by allowing firms to transfer their non-debt tax shields to firms that place a higher value on the deductions. And in a D'Angelo and Masulla's capital structure framework, which I'm not sure if you're familiar with, but basically D'Angelo and Masulla's have a model where they introduce non-debt tax shields like depreciation and show that that can result in interior optimal capital structures for firms. Well, here we're saying that, look, if you transfer away depreciation as a non-debt tax shield away from the firm to another firm, then you leave the ability of that firm to increase its debt because it doesn't have the redundancy between the non-debt tax shield and the interest tax shield anymore. It's gone away, allows them to put on more debt. So just in a tax framework, we get the potential complementary effect between debt and lease. Leasing allows a firm to take on more debt. Now, as I mentioned, there's this paper recently by Eisfeld and Rampini, RFS 2007. They show that lessee firms can potentially increase their debt capacity because leasing has a repossession advantage that we were talking about, and lessors are more willing to lease to financially constrained firms, but this is countered by the agency costs of leasing because lessees are not going to take as much care of the asset as if they owned it. So that's the trade-off in Eisfeld and Rampini. And then they do empirical analysis using thousands of firms from a census database, a U.S. census database, and they find a very, very pronounced relationship between the size of the firm and the amount of leasing. That is, the very smallest firms in their sample of tens of thousands of firms use a lot of leasing, whereas this just monotonically decreases as the size of the firm gets larger. So they claim that size of firm then is very much a proxy for financial constraint. Financially constrained firms are probably the smaller firms, and therefore that result they claim is consistent with this model. Now there's some other literature on leasing. You're probably familiar with this pretty classic paper by Klein, Crawford, and Alchian. They talk about firm-specific assets are more likely to be owned, vertical integration, and more general-purpose assets are more likely to be leased. Smith and Wakeman talk about all kinds of agency problems in lease contracting. They don't really have a model. They just, discuss these things, and they discuss such things as, for example, there's metering arrangements in lease contracts. Some of the classic agency problems, such as the overinvestment problem or the asset substitution problem, can be resolved with a lease contract because you can't substitute the asset when you don't own it, and things of that nature. So that's the discussion there. And then there's finally, John brought up information costs, and this is an open question here. I just put a question mark there. Off balance sheet advantage to leasing. We know that companies seem to want to put debt or leases off the balance sheet. And the question is, why? I mean, obviously, it makes them look like they have less leverage. But it has to be disclosed in the footnotes, according to the accounting rules. All of the students that we teach accounting and finance to know how to go to balance sheets and financial, or at least they're supposed to know how to go to the financial statements and look up the footnotes and find out how much. And in fact, when you look at these like credit reporting agencies such as Standard & Poor's and Moody's, they automatically capitalize any off-balance sheet finances. I mean, that's built into their programs. It's automatic. So the question is, what is the value of off-balance sheet financing? Why are firms willing to actually pay significant transaction costs to turn balance sheet leases or debt into off-balance sheet items? And of course, you look at cases like Enron and WorldCom and so forth, and you can see what happens when they get found out. But what's the big advantage there? So I think I don't have an answer, but I think it's a huge question.
I was just wondering, all these sorts of models, do they just assume that there's risk neutrality on the part of these firms because they're firms, not consumers?
I think for the most part, yes, they would.
I was just wondering if it was an item where at the end of the 3 years you still own it or you don't own it. I was just wondering if it had anything to do with uncertainty about what could the scrap value turn out to be high or low, and you had different attitudes towards risk.
Yeah, clearly, people make the argument, and I mean, I think it's valid that where there's uncertainty, about the residual value, and there almost always is, if you have certain expertise in this residual value market, or say the secondary market, the market for used equipment, then you have an advantage. But clearly it's an information cost, and I mean, a lot of people will lease computers, for example, because they don't want to worry about the disposal of the computers. Yet the computer leasing companies, that's part of their job is to take used computers and then either release them, sell them, or somehow dispose of them.
Couldn't that be the same thing with the small firm, large firm thing? Because the small firms are leasing more than the large firms because small firms are riskier?
Right, riskier because of information and translating into credit, credit worthiness and risk and so forth. Right. I think that's the basic idea behind.
Not the size as much as what the size represents.
Right. Right.
These would be traded on the capital market.
No, well, the one in the Eisfeld and Rampini study, they used U.S. Census data, so they actually had firms that were proprietorships and partnerships all the way up to large corporations, so they had the whole spectrum. And then they also did the study with, say, which is CompuStat firms, which are publicly traded, and the same result held true, although it was very pronounced when you include these really small firms. So there's a huge leasing market for your startups your mom and pop operations, your proprietorships, and so forth.
Really small firms don't want to go to empty lots.
They can't. Yeah.
So the dividend model doesn't apply.
Well, yeah, I mean, they don't have access to all the capital markets. And that limited access is due to information costs, and then that translates into risk and so on and so forth. So I think it ties together. John?
Could you think of a real options perspective on the leases? I don't know how common it is, but suppose you lease a truck or a car, and there's sort of there's an option to purchase at maybe a blue book price or something like that. And so, in some sense, then the intuition would be, the bigger the uncertainty about the resale value, the better it is if you've got that option. The option value goes up with the
Yeah.
increase in certainty. But I don't know how common that is in a lease contract.
I mean, some of them do, some of them don't. It's all over the map. So, traditionally in the U.S., there has been an option to purchase, but due to tax rules, that option could not have a fixed price. So it was like you can purchase the asset, but at its fair market value at the end of the lease. So that option had no, value at the beginning of the lease, except for maybe some small value of having to remove an asset and replace it or something like that. Then the tax laws kind of evolved over time, and the tax authorities then said, well, you can have a fixed price purchase option, but the exercise price or the fixed price has to be basically your best estimate of that future value today. So basically an at-the-money option was allowed.
But if you have
that's
a
kind
spread
of,
of that, you got a mean value.
That's right.
And then your option
Yeah.
is quite
right, and
you take advantage of it if the prices are right. If you don't,
Right.
you don't.
right.
I'm just wondering if that.
Again, I mean, my only question is in, again, in quote, perfect capital markets, or, you can price that option, and so that should be priced into the contract. But, I mean, I've been teaching a real option course here, and we just went over that real option today in class. So I think it's there. I really do. But whether it really accounts for the differences between debt and leasing, hard to say that component would do it. Okay, I'm focusing in this study not only on the differences between debt and leasing, but particularly on the sale and leaseback transaction. And the reason I'm focusing on the sale and leaseback transaction is because previous studies that have looked at this debt and lease substitution are looking at new leases. But new leases mean that you've got to add a new asset to the firm by nature. You sign up for a lease, you get a new asset. That's part of it. So it's a little bit hard to say, well, it's a little bit hard to control in the experimental setting just what's going on when you're adding a new asset. So what we do is focus on the sale and leaseback transaction, where the firm is not changing its asset. It is merely selling, receiving cash, and leasing it back. And so in the instance of the sale and leaseback, there really is no change in the assets of the firm. Some other people have looked at sale and leaseback transactions. Kim, Llewellyn, and McConnell look at it from strictly theoretical point of view, and they suggest that sale and leaseback transactions can result in wealth transfer because it violates me first rule. That is, secured debtors or senior creditors would be first placed to the assets, but if you sell them and lease them back, now the lessor steps to the front of the line ahead of these senior creditors. And then Puneet Honda in 1991 has a signaling equilibrium whereby good firms own, because they can take full advantage of tax shields, they have lots of earnings, where bad firms favor sale and leaseback transactions because they want to hedge against the risk that their earnings are low and they can't use all the tax shields. So that's his model. And he actually does empirical analysis and finds that at the announcement of a sale and leaseback, there's a negative stock price reaction. But several other studies have also looked at the event study of a sale and leaseback transaction and find positive stock price reaction. So I'm not exactly sure why his numbers differ. The data that we're using basically has a positive reaction to sale and leasebacks, but we don't really look at that here. Okay, so some of the evidence on the substitution effect. There's a paper by Bayless and Dilts, 1986, that find that $1 of leases displaces about 85 cents of debt, and their analysis was done with a survey. They surveyed firms and said, look, how much leasing would you offer this particular firm with all these different characteristics? It was a survey analysis, and then they tried to quantify that. Marston and Harris look at changes in balance sheet, debt, and leases, and find $1 of leases displace about 60 cents of debt. This other, Beatty, Goodacre, and Thompson, look at UK data, find a pound of leases displaces about 0.23 pound of debt. And then finally, a more recent study by Yan in JFQA 2006. I thought this was pretty clever. He uses a simultaneous equation to get around, some of these problems of, holding the assets constant and so forth. He uses a GMM approach, which I thought was pretty sophisticated. But then for instrumental variables, and this is the big problem when you do this kind of analysis, because what determines leasing and what determines debt? Well, in fact, about the same things. The same things that determines a firm's use of debt are going to also determine their use of leasing. So it's almost impossible to find any set of instrumental variables that are going to differ for those two types of contracts. So to get around that problem, he just uses lagged dependent variables. So I don't know econometrically if that's a perfect solution. I don't think it's a perfect solution, but it does result in his finding that he cannot reject the hypothesis that debt and leases are substitutes, but he does reject the hypothesis that they're complements. So that's the result of his analysis.
So kind of that's a really basic question I should have asked in the front end. So theoretically, it can be a substitute. These can be substitutes or complements. So and you got theories that can provide
justification. Yeah,
results,
right.
So is the practical bottom line of being able to nail down a number you believe in, the motivation behind that is so you can, in a sense, say this theory is the one that predominates in this context here? Is that basically where the motivation here is?
Well, I think a couple of things. One is I'd like to find out, on average, do leases and debt appear to be substitutes or complements? And then as we,
That's just an interesting thing to know about that market.
Well, because it's an open question, and because I view it as part of sort of fundamental capital structure theory. I mean, we know, we've got these theories of optimal capital structure, trade-offs theories, pecking order theories, and so on and so forth. But what do we know about these two types of securities that seem to be so close, and yet we can't really nail down whether you add more leases, you've got to reduce your debt accordingly, or not. I mean, that's one thing. And the other thing is, I would like to see a little bit of a horse race between these these different theories. The theories may not be mutually exclusive, certainly, but what does the evidence tend to support which theories? So that definitely is also part of this analysis. Seamus?
But it's really interesting as well. Just in terms of motivation, sort of my naive first year econ brain, I've got a couple of curves, one downward sloping, one upward sloping. The upward, when you've got leases and debt on the axis, the upward sloping one is being affected by different tax treatments or asymmetric information treatments, is saying sort of what proportion of my total exposure I want to be debt versus lease.
Mm-hmm.
And my downward sloping one is just moving up and down according to how much total debt plus lease that I want. And so maybe because basically it's like supply and demand, either of them can be moving around, so you don't expect to see anything in the data.
Mm-hmm.
It's not so much that are they complements or substitutes, they're clearly substitutes, right?
Mm-hmm.
In one sense, the interesting question is, what's the slope of that downward sloping line? Is it exactly one, or is it?
Yeah.
Although the econometrics question is not, is it upward sloping? Theoretically, it's got to be downward sloping. But if we can extract movements along versus movement of, is it got a slope of -1 or minus 0.6 or something like that? But I can't imagine how debt and leases could be anything other than substitutes.
Well, yeah. I mean, so my argument is, my model with Lewis is that in basically a capital structure taxes only imperfection world, that leasing can potentially allow the firm to take on more debt, increase its debt capacity, if you will, or increase its optimal capital structure. So in that sense, they can be complements. And then the Eisfeld and Rampini argument that again, leasing can increase your debt capacity because the financially constrained firm can borrow or lease more because they're because the lessor is more willing to give them funds.
So in terms of
It seems to me that's asking the question directly, which of those two curves move more?
Yeah.
Then it doesn't become an econometrics problem. You look at the data and see which is the correlation, because you're asking a reduced form.
Yeah. Well, yeah, and I try to look at some of that. So I might be addressing some of what you're saying, but if I'm not, no, come back and let me know, because I think it's a really good point.
If you follow through Seamus' idea, Seamus, what if you think of an opportunity set? And what I'm sort of thinking of Jim is, I'm down there in the lease. I've got a lot of leases, not too much debt, and if I want to, we're thinking substitutes. I think, well, if I cut back my leases and I take a little bit more debt, wow, a bunch more opportunities open up for me, and so I'm folding out along that thing. And then, I'm just trying to think of, is there an opportunity set that you're saying it's a feasibility question rather than like a buck? If you're going to raise a buck, you can either do it by debt or by lease, and it's got to be downward sloping. But let's say that's my intuition. But on the other hand, this contracting thing says, well, maybe by switching the type of contract, you allow yourself to open up, you can borrow more than $1 in total by restructuring yourself.
Right.
Is that right? I'm thinking more of an opportunity set in your section.
Yeah, I think that's what I'm, trying to investigate. Is that possible?
I'm trying to make sense of my two colleagues' comments here. So what you're saying, John, is that it's not demand curve and supply curve. It is just demand curve in a sense. That would be, I think, what your response would be, Jim. And there are some endogeneity issues empirically, but it's not a matter of, the demand curve can, in a sense, we have income and substitution effects, if you want to think of it in a labor supply sense. I'm saying that, but they fit into the demand curve in the sense this when you take on more leasing, it allows you to borrow more. That's in a sense like a wealth effect, vaguely. So it doesn't have to be thought of as different curves. Is that not correct?
I don't think you have to think demand and supply. Seamus was two different relationships. One fruit, possible. It's your capital structure, which is the, and then there's your was thinking, okay, you've got maybe it isn't a straight line thing because you've got at some corner it might be possible that you're actually moving upward, then you get into a quantitative chain and you come back down, something like that. There's something in the nature of transactions that leads to an opportunity set of this, and it's upward sloping in some portions, and it goes to the negative slope, and then it comes, like, I mean, it's just a geometric inversion thing. We're pictorial guys, okay.
Yeah, and I'm not used to thinking about the capital structure in this kind of graphical framework. But
see, my view, I'm not sure. I think it's more similar to Seamus, but it seems that whenever you're in a situation where your optimal capital structure would change, right? For instance, there's less asymmetric information. Your bankruptcy costs would go down. You would take on more debt, right? And you will always do it in different ways. You will take it on by having more leasing, as well as getting more bank debt or issuing more bonds. Right? So in those cases, you would see the complementarity result.
yeah, I guess in terms of graphic representation, oh no, here's the special. We usually graph capital structure, so you have some sort of debt to asset or debt to value over here, value over here, and our optimal capital structure sort of trade-offs theories give you something like that, and so now you have some optimal level of debt at the firm level, and so what we're suggesting is that somehow, say leasing then, because of either the tax story or the bankruptcy story, was going to shift this curve, so that it increases your debt capacity. That's the kind of story I think that's typically told in these.
Each of those curves would be conditional on a certain amount of leasing.
Right.
And all the change now is moving back into leasing in the LD space.
Mm-hmm.
Okay.
We're both in LD space. We're both in
Yes,
LD
yes.
space, that's for sure. Different variables.
Okay, so now our first hypothesis is that debt and lease are substitute. That's the lambda, the Myers-Dillon-Batista lambda parameter between 0 and 1. And let's start off by just an accounting sort of value identity here, that the assets of the firm are the debt, leases, and equity. The changes are represented as such. In the instance of the sale and leaseback, we're saying that the assets don't change. We assume that the equity doesn't change. And so, so we have the change in lease would be equal to the change in debt. And then we insert here that Myers-Dillon-Batista lambda to try to figure out just how much debt is substituted for leasing. So this is going to be our first estimation equation. And I add a little corollary here that lease substitute for long-term debt financing. The basis for that argument is that on average lease contracts are longer term. The average term, different studies show about 5 years, about 60 months for a typical lease. And clearly, they're going to be longer than 1 year because, they just simply are longer term contracts. So I'm going to test also long-term debt.
Okay, so here's a really stupid question. So if that's an identity that we're starting from, how do you get it to be any less than 1, anything different from 1?
Well, because we can't measure the instant of the sale and leaseback. I got to use accounting data. There's going to be lags. There's going to be all kinds of measurement problems, to tell you the truth. And so
But those are measurement problems. They aren't for estimating the data generating process of
Yeah.
each year.
Yeah.
What we want is what the real process is. The real process is, by definition, it has to be 1. If we get something different,
Well,
from 1, then we say it's a measurement
Right. Well, the other issue here is that the firm does not have to necessarily substitute. That is, if they add leases, they don't have to necessarily decrease their debt. They can. They've got cash from the sale. They can pay down the debt, or they could do something else with the money. So.
But then shouldn't that be an equation?
Well, I don't think I put it in the slide, but in the paper I show you that if we don't assume that delta A is 0, then obviously we're going to have the change in lease will be minus delta times this. What is it? Minus some change in asset variable as well. Well, yeah. I mean, clearly, if this is the optimal capital structure of the firm and debt and leases are, just substituting for each other, then, anytime I increase my leasing, I've got to pay down the debt to get exactly that same spot again.
But with the idea of a lender of 0.5, I want to increase my leasing by a value of $2 for every $1 I reduce debt to keep basically the value of the company. So for a given number of shares, the value of the share is the same.
Okay, but I think the issue is, as Bob's pointing out, if I've got this $2 from leasing and I only use $1 of it to pay down the firm, then what am I doing with the extra $1? And
Well, it might be putting it in the bank because the tax treatment is different. So
Right.
I need that to
okay, but then you've increased the assets by $1 because it's just cash, So
yeah, but all these things that you've talked about, like different tax, the reason why land does not want different tax treatment or different first rules under bankruptcy and so on, and so presumably the value of my assets to my owners is different for land less than one if I do a street transfer.
Isn't there changes, in the graph you've got over there, D is a nonlinear function of D. And so over here, you've got an accounting identity, but the real thing isn't your assets, it's the value of the firm.
right,
If you think of that as V of L and D,
yeah,
forgetting about E,
Yeah, right.
V of L and D is some function, and then there's a marginal substitution between L and D, and that's lambda.
yeah.
Which isn't necessarily right. I mean, not right, but I mean, taking this graph here, and if we think of L as a variable that isn't represented on that graph, but we know value is dependent on leases, and it's dependent on debt and some equity. Okay? But forgetting about equity, we've got
Yeah.
a constant V. You'll have a trade-off between L and D. I don't know if it's convex, concave, or maybe in portions. I still think it's in portions it's going to be upward sloping, and it'll be a negative sloping point, and then another.
Yeah.
So that would suggest that our initial equation shouldn't be that accounting identity. Our initial equation should
Be the value.
Valuation.
Yeah.
And then you can get something like that. That's the part that bothers me, starting
Okay.
from there and ending up with that where
Yeah.
it doesn't seem to follow.
Okay, so so we should set this more in valuation framework than accounting. Yeah. Yeah, I like that. I think that makes more sense. Ron?
Also related to Seamus's comment, I think, if you look at the last equation, right, then econometrically, you get the simultaneity problem with the epsilon and the change in long-term debt being correlated. Right, so that is what causes your estimate to be a reduced form one rather than structural.
Mm-hmm. Mm-hmm.
And so what you really need in terms of modeling is you need to know why the particular lease agreement occurs, right?
and I try to handle that with control variables, which is coming up, but in the pure sense, you're right. Yeah, I agree. So, like I said, we add control variables: size, interest coverage, marginal tax rate, capital expenditures, and real estate. Let me tell you why I have these particular control variables. First of all, size was Eisfeld and Rampini's number one variable. They basically said, look, this is the variable that stands for financial constraint firms. Interest coverage is also a measure of financial constraint. The marginal tax rate, that's the variable that we talk about, Lewis and Schallheim, in terms of the substitute or complements in a tax framework. And the marginal tax rate here is measured according to some rather complex algorithm that John Graham has publicized and popularized, and it's, if you just go to his website, you can download these marginal tax rates. But it's a very sophisticated way of measuring the marginal tax rate using simulation. It's very forward-looking, which happens to be very compatible, I think, with leasing in a forward-looking way. And so then capital expenditures, because that's what we're proxying for in terms of changing of assets, which is not, we're not holding that constant when we add these variables. And then finally, a real estate dummy has been used by previous literature because they found different effects for real estate versus equipment leasing. That's one reason. Another reason is that some people argue that when you think about the asset specificity types of arguments, well, maybe real estate is less firm-specific asset and equipment is more firm-specific. So those are a couple of reasons why to include the real estate dummy. As it turns out, it has no impact at all.
So, and just following up on his previous comments, so if this is where it'd be really helpful to start the model off as a valuation equation as you're optimizing and getting your equation from there, because if the source of the endogeneity is omitted variable bias, then putting in these control variables solves that problem. But if the source of the endogeneity is that these variables affect jointly the choice of leasing and these dependent like-hand and planetary variable, then putting them in as control variable doesn't solve the problem. So it does go back to what the initial framework is that you're trying to derive your estimated equations from.
Yeah. Yeah, that's another good another good reason to go with that approach. I agree. Okay, now after we do this first part, and now getting a little bit at maybe at what Seamus was suggesting earlier, which is we divide the sample into two groups. Okay, the company has done the sale and leaseback. They've got the money. Now, what are they doing? Are they decreasing their debt? They're paying down debt? Or actually, subsequent to the sale and leaseback, are they increasing their debt? So we simply divide the sample into those who decrease debt and those who increase debt. Turns out, if I remember correctly, 60% decrease the debt, 40% increase the debt in the sample. And so when we look at the group that are substitutes, but they're not perfect substitutes, then we expect to see changes in assets related to the sale and leaseback transaction. And again, we're using capital expenditures to proxy for that. And then the third hypothesis looks at the subsample where they actually increase the debt after the sale and leaseback. And here we want to see, well, are firms in lower tax-paying positions, which would be consistent with the Lewis and Schallheim model? Are they more financially constrained, which would be consistent with the Eisfeld and Rampini argument? Or And then also, are they increasing their capital expenditures with the additional monies that they get from the sale and leaseback transaction? So those are the things that we're trying to examine empirically. And here's our data description. One thing I wanted to point out was that the lease to asset ratio here, I think, is substantial. So these are not by any means tiny transactions. They're quite substantial. 19% mean and 12% median of asset value, book value of assets, I should say. Of course, the way this data was gathered was by looking at Wall Street Journal and other financial press announcements. So they have to be significant enough to show up in the financial press. So, so that's a little bit of a bias, but that's what we were looking for in terms of these transactions.
Can you characterize what are these leases? Primarily computer equipment?
Well, one thing, if you see the real estate dummy here, nearly 88% have at least some real estate involved. So many of them are they could be office buildings or they could be retail, big department store, all groceries, all those kinds of use a lot of real estate. Let's see, aircraft is big. So those are some of the examples that come to mind.
On your lease to asset ratio, where do you get that data?
Okay, so this is the amount of the sale and leaseback transaction that we observe.
And where do you get the asset?
The assets is measured, I might stand corrected, but I believe we measure the assets at the last accounting statement prior to the sale and leaseback transaction.
Could you do market values?
We
Obviously, you could only use publicly traded firms to get market values.
Yeah. Well, I think we've merged our data with the CompuStat, and we do have like monthly stock returns here.
Because
So
if you switch to the value approach of,
Yes.
of the world,
Yeah.
And of course we always the capital structure, we also have students
Yeah.
to do market values, not
Yeah.
book values.
Yeah.
So I just wondered if that would be.
Yeah, we can do it. My gut feeling is that, and having done a lot of capital structure types of regressions over the years, it won't make a difference. But definitely that would be the way to go. And so that would be the better way to go. So yeah, we can do that. John?
Given the size of that real estate, I mean, would it be better to almost have two tables? One for the ones that involve real estate and the rest. Because the two things I was interested in was the lease to asset ratio, which is obviously skewed, but my guess is it's going to be very different for the real estate guys than it is for the rest of these transactions. I'm not sure, but I guess. And the other thing is duration. If you don't have an entry for the duration of the lease contracts.
Yeah, I'm not sure that we actually can collect that because we rely totally on just the announcement. Now, I suppose, well, even in some cases where I've gone to financial statements to figure out what they release, you don't know. Yeah, so one of the problems of doing studies of leases is that they're all private contracts, and so yeah, so you can't get much information. But that would, I'd love to have that. Yeah, I mean, our sample size of non-real estate transactions is going to be, a lot smaller. And I think that, for example, the Eisfeld and Rampini study did separate their sample into real estate and non-real estate transaction. And clearly, for example, I told you they had this very pronounced downward sloping. Small firms, high level, 40, 50% leasing, down to the large firms did very relatively smaller amount of leasing. But that slope, if you take out the real estate transactions, it's still downward sloping, but it's a lot flatter. So there's much less in just pure equipment than there is when you combine real estate with it. The other thing here is if you do look at the returns, I noticed it's a negative. This is raw returns prior to the sale and leaseback transaction, negative 6.7%. Median is 1.5%. These firms are not necessarily doing really well prior to the sale and leaseback transaction, which would be consistent with some financial constraint going on in the data. Here's our first regression analysis, and the first one here, number one, is all of the leases against, so the sale and lease back against the change in total debt, basically nothing going on. So neither, if you want to say substitute or complement, appears to be going on in the total sample. 302 observations there. If we look at just the long-term debt, which was my corollary, we do find a significant negative relationship. So on average, it appears that firms are substituting about, for every dollar of debt, about 31 cents of debt. That's what it looks like right there. Now we add all those control variables that I mentioned and do these things again. And now for the total sample, total debt sample, we get about, close to the previous one, 31 cents, 32 cents.
I'm just looking at your paper. I don't understand here. So what time period is involved here? So an announcement, you find an announcement about the
sale and leaseback transaction.
And so how much either before or after that do you look at to examine what happens with that?
Well, so we look at the financial statements and annual statements, the year end before the announcement and then the year end after the announcement. And so a lot of things, of course, can be changing over that time, but that's as good as we can get in terms of the data. We've tried to use quarterly, but first of all, you lose a lot of sample, and the results qualitatively don't change, but we lose a lot of sample size. The other thing to notice here is that the size variable is also highly significant. The capital expenditure variable is highly significant, it's significant, and that's it for the control variables. And our changes in debt hold up whether you just look at total debt or long-term debt, and we even looked at short-term debt separately, although I don't really have any particular story about the short-term debt, except to say that if firms do a sale and leaseback, they've got the money, they can pay down long-term debt, they can pay down short-term debt. That's available to them. Now, this is where we're going to look at the substitute subsample. So this is where we screen on whether they've increased or decreased their debt, and this is the sample that decreased their debt after the sale and leaseback. This is the correlation matrix, and the one thing that's kind of interesting here to me is that the marginal tax rate is significantly correlated with the interest coverage ratio. So I'm trying to figure out whether taxes is driving some of this stuff, or whether financial constraint is covering these things. And I just want to note that these two things are correlated. It's very hard to separate those two effects. I'll show you what I do. I'm trying to separate those two. Okay, here's just a substitute regression. We run the same regressions that we had before with just the total debt, just the long-term debt, and then with the control variables, which again were size, real estate dummy, capital expenditures, marginal tax rate, and interest coverage ratio. Of course, I expect to have negative, parameters here because I selected on the ones that decreased their debt. And it's interesting that the highest substitution parameter that we can get is 0.78. So again, and that's significantly different from 1. So we don't get anywhere in the slicing and dicing this data. I don't get anywhere quite up to 1 perfect substitution between debt and leases. The other thing is that, again, size is quite significant. Capital expenditures are quite significant. The marginal tax rate is not, except in this one case right here. And interest coverage shows at the 10% level some significance. So basically what I conclude from this graph is that for the substitution subsample, size, that's the kind of financial constraint variable, seems to be important. And the interest coverage also confirms that kind of financial constraint story. They're not perfect substitutes, but they are increasing their capital expenditures, so the money seems to be used both for paying down debt and increasing assets. And then finally, the marginal tax rate doesn't really come in. So taxes do not seem to be telling much of a story for this subsample. Graham?
This probably relates to a lot of the questions that were asked previously, but
well, they were good questions.
To the extent that this is supposed to be structural and not a reduced form, so I can't understand why you put the lease and sale backs as the dependent variable and the debt as the independent variable, because whenever you've been describing to us anecdotally what's going on, and I come to this knowing nothing about it, to start with, it sounded like with the picture that you drew there, it sounded to me like the way you put things was, well, we have a sales and leaseback agreement, and then, well, what are we going to do with the money? Are we going to use the money to pay off some debt, or use the money for some other purpose? So it kind of sounds to me the other way around, like that you have the sale and leaseback agreement, and the question is, how is that going to affect your debt position, rather than you want to change your debt? I mean, both could be going on. That's I guess what everybody was saying earlier, which makes it
right.
But anyway, the story that you were telling seemed to be in the form that you have your sale and leaseback agreement, and then you figure out how you're going to dispense the funds,
Right.
and how that's going to affect debt. Almost makes it seem like the debt should be the dependent variable, and the sale and leaseback should be the independent variable.
But it does have this simultaneity about it, and
of course, that's
yeah.
But then,
Yeah, but the other thing too, though, is
it has to be thought of as completely, as Shane was saying earlier, as a reduced form kind of analysis.
yeah,
Which means I think it has to be verbally presented differently.
yeah. Well, or maybe some simultaneous equation approach to this might get at some of that. But that, of course, that introduces econometric problems of all kinds. So, yeah.
So I think going back to that very first accounting magnetic that we didn't like, and then thought we should have a value function there, and then that would say in some sense your dependent variable should be change in valuation, right? And then and since and both of these are in a sense are endogenous choice variables on the right-hand side, change in debt, change in lease, and how it affects valuation.
Right.
And then you have a specification here where you've got not the change in total assets, but you've got level of total assets. But if there's been a change in valuation in the
Yeah, I mean, we did, we don't have that in there. And this was
I
just...
go back, I think, to the, and again, I don't really understand all
Yeah.
the different things that we said here,
Yeah.
but this seemed like the framework was assets left-hand side,
Yeah.
and, these other things on the right-hand side.
Right.
And now we have a specification where I've got, left-hand side variable is now my change in debt, or change in leases.
Change in leasing,
And
yeah.
the right-hand side variable, I've got assets. And that was okay in an accounting identity where I could just move things around, but once I start talking about a behavioral equation, which I did have a kind of a model with assets as my dependent variable.
Right.
So I've got a problem when in that moving that the right-hand side.
Yeah.
And then I just,
But it does-
the whole
I mean, it
question
does-
about how to
yeah.
even, like, going back to what Seamus said, it seemed like his understanding was that Landon was in a sense the trade-off between changes in lease and debt that would hold assets the same. And I thought that's what was said. Value same, I'm sorry, yeah.
Yeah.
So, in which case, if you had your dependent variable being a value
Yeah,
measure,
right.
then you would look at the ratio of those two coefficients to get a sense of the trade-off to hold valuation constant.
Right.
Again, ignoring the whole
Yeah.
valuation problem here.
Yeah, and yeah. So, I mean, again, I agree with you that the valuation approach has got to be the way to go
Okay.
with this. And thank you.
A is just a number that pops up. Book value is like
Right.
L plus D. This is what I spent, but it doesn't tell you anything about the value of the curve.
Well, I thought what Jim said earlier, though, we found that in his own work that
No, that was-
book value was a pretty
that was
good proxy for.
In the trade-off between debt and
Yeah.
Well, in the in capital structure
Yeah.
sort of regressions,
Yeah.
usually when you do these type of regressions, it's not going to matter whether you use, say, debt to assets versus debt to value,
Uh-huh.
because basically, when you do value, you take book value of debt and add, market value of equity
Yeah.
to it, and it does change magnitudes, obviously, but rank order, probably doesn't change a whole lot, and therefore your correlations pretty much work out
Mhm.
about the same. I haven't seen really any study that showed a substantial difference between using book value or using market values in those type of regressions. Now, and of course, in the simultaneity situation we're facing here, there's a lot of complications running on. I'm going to have to think about that. Maybe I can sit down and talk to you about this a little bit later, because it's, I think that's the right approach to go. And I've been looking for that kind of a comment, because I haven't been really happy with this analysis, but I wasn't exactly sure where to go next. Yes.
Can you look at the returns, the stock market returns around the time of the lease agreement?
Well, yeah, and people have done that. Yeah.
But it seems like a good way of separating your sample. In some sense, when there's not much of a stock market reaction, those would be the cases where the lease agreement is kind of an exogenous event, and where you would expect perfect substitutability.
Mm-hmm.
And so it might be a way to get around the endogeneity issue.
Yeah. To separate based on abnormal returns around the event.
Yeah, so if the abnormal returns are close to zero,
Yeah.
then there's not much going on, and so you get...
Yeah, no value. Yeah. Okay. That's a...
But so that's a question, would that find one?
That's only one of these book value is a good measure. I still think there's pretty some curvature to the VALV function. That's all it's. If it's book value, then it's value. But if it's market valuations, then there's going to be some. I mean, I'm just thinking the repossession thing. I think this is really instant. I'm going to come with that. Now I know why the Crown leased high country land to these guys and sold it out to her and said, get financing, because they'd stand first in the queue when the guys went bankrupt. That's why they did it.
Okay, just to complete the story here, we look at the complement subsample. Again, I note that the marginal tax rate and the interest coverage ratio are significantly correlated. I'll come back to that. And the interesting thing here is that without the control variables, I do find this positive coefficient here, which is, again, because this is the complement subsample, that's what we expect. However, the significance of those variables go away with the controls, However, let's see, capital expenditures are marginally significant, but the marginal tax rate comes out quite significant. So I am interpreting this as more consistent with the tax story, as in Lewis and Schallheim, versus the financial constraint story. But the final thing we do is trying to address that correlation between taxes, marginal tax rate, and earnings. What we do is put earnings quartiles here, marginal tax rate quartiles here, and see if any way to distinguish between the two effects. And what I find is that the marginal tax rate row totals here pretty much march downward, and in other words, as the marginal tax rate decreases, the leasing increases, and but for the earnings quartile, I sort of have some kind of a smile or smirk here, and it doesn't work the same way. So again, I'm interpreting it as being more consistent with the tax story than earnings risk or something like that. So that's the last thing we do in the study. So, and I think I'm out of time. Yes. So conclusions, tentative and subject to revision here. But in the overall sample, we saw no effect between the leases and the debt, overall debt. The long-term debt and leases does seem to show a substitution effect. In the presence of the control variables, the overall sample does show the substitution effect. When we look at the substitute subsample, substitution gets a little closer to 1, but capital expenditures are significant, and I forgot to write on the slide, but the size and interest coverage ratio were consistent with the Eisenfeld and Rampini was significant. In the complement subsample, only the marginal tax rate basically and capital expenditures showed any significance. So the substitute subsample seems consistent with Eisenfeld and Rampini, while the complement subsample seems to be more consistent with the tax story. So anyway, those are the tentative conclusions, and I appreciate your comments. Any other questions?
Okay, let's give our...
Thank you very much.